With copper prices surging amidst the energy transition and supply constraints, mid-tier producers like Sandfire Resources are in the spotlight. My name is Louis. I'm a mining engineer and finance professional. Today we're taking a look at Sandfire Resources, an international copper-focused resource company with a market cap of around $8 billion Aussie at the time of recording. We're going to take a look at their operations, some of their key costs, their financials, and whether or not you should invest in this company during what some are calling the copper supercycle. As a mining engineer and finance professional, I'm going to try and make this really simple. When I look at companies like Sandfire Resources for a general health check and a high-level overview of whether I should invest more time looking into these companies, these are the things that I'm going to be looking at. I'm going to be sharing this with you so that you don't have to. All the information that I'm covering today is publicly available information detailed in the Sandfire Resources financial reports and their quarterly reports. Sandfire Resources is an ASX-listed mid-tier copper producer with a strong track record of safe and profitable operations. Originally built around the high-grade DeGrussa copper gold mine in Western Australia, it's now in care and maintenance, the company has transformed into a global player through acquisitions and developments. The Matsa complex, located in Spain, was acquired in 2022. It's a polymetallic underground operation producing copper, zinc, and lead concentrates. It's the cornerstone of current production. The Motheo copper mine, located in Botswana, is a newer open pit operation that's ramping up, marking Sandfire's successful entry into Africa. The company has got various exploration and development assets in the US and elsewhere, but for the purposes of this video, we're not going to focus on that today. Matsa relies on modern underground mechanized mining techniques across multiple ore bodies, has a few different processing plants. You can see here across the map, these are located within Spain towards the border with Portugal. If we're just looking at ore, which is basically all the material that contains the copper material and all the other byproducts we mentioned, we can see here there are three main areas of interest. Now, the most important thing that these graphs highlight is that for the most part, it's steady state production. The information shown here looks at the FY24 actual production in green, the FY25 actual production in blue, and the FY26 estimate for full year, as well as the Q1 performance so far. Looking at this at a high level, I don't see any issues here. So that's the first tick. Next, let's consider the concentrate, which is effectively the product that the asset would sell onto the market. This is what is loaded onto ships and contains all the metals that the company sells. Firstly, let's consider the company is producing copper concentrate. And we can see in here that it's relatively consistent year on year, FY24, FY25 in the blue and green, with a bit of a reduction expected for FY26. Recoveries seem acceptable. The most notable thing here is that it seems consistent. There's a bit of a dip here in Q4 of FY25, which we can look into later on, but for the most part, it seems relatively stable. The company also produces a copper poly concentrate, and we can see in here that the company is expecting to produce more copper in FY26 from this particular concentrate. Again, recoveries are lower, which is probably a factor of more challenging metallurgy in terms of trying to separate all the byproducts from the copper. But again, we're not seeing any major deviations here. So for now, let's consider this okay. If we consider then how much copper is actually within the concentrate, we can see here that looking across FY24 to FY26 estimate, there is a bit of a drop off happening, but it's relatively minor and the concentrate grade seems to be consistent as well. Now let's look at the Motheo operations in Botswana, which is in Africa. These are open pit mines. One is still ramping up, busy or finishing in development. The other one has been a bit more stable and ongoing for a while. The first thing that caught my eye here is that you can see the existing mine, the T3 mine, and the A4 mine, which is the newly developed mine, coming online towards the end probably of FY25. And what we would expect to see in years past FY26 is that there will be a bit more of a balanced contribution from each of the assets in terms of ore produced. Also worth mentioning is typically with open pit mining, there's always high grade ore and low grade ore. Companies like Sandfire and every other company will prefer high grade ore. It's got more stuff in it, takes less energy and cost to get something out of it. But you just can't get that. It's bulk mining. And so what will typically happen is a lot of the low grade ore will get stockpiled and used on an as need basis. We can see from the graph on the right, the company is producing slightly more ore, mining slightly more ore than what it is processing, the processing being shown in the green line. But there is a relatively stable split between what low grade and high grade ore is. This means that the company cannot just stockpile everything that is low grade. It does rely on low grade stockpile to supplement its processing capacity every year. This is not a bad thing, it's normal, but it is worth keeping in the back of your mind. If we look at the concentrate that the Motheo asset produces, we can see again that it seems to be a slight ramp up from FY24 to 25, which is good. And then FY26 level, or the forecast rather, seems to be relatively consistent with FY25. Now, of course, the A4 mine is ramping up and the T3 is already ongoing. So there's no issues here. We can see generally from the recovery also that it's a bit higher than what we saw with the Matsa operations. This is because there's not a lot of noise from other byproducts that's making it difficult to process the ore. Now, before we move on too far from the operations, it's also worth pointing out that the Australian company, Sandfire Resources, with a head office in Perth, their one operation is in Spain and the other one is in Botswana. This is not necessarily a bad thing in its own right, but it does, of course, present some challenges with keeping across everything that's happening in the company's portfolio. Next, let's look at what the company is spending its capital dollars on. Now, if we look at this extract from their financials, the FY25 full year, we can see that from FY24 to FY25, the total capital dollar number is about the same, $210 to $208 million. Most of the capital the company is spending on is on mine development and sustaining capital, with a bit of strategic. Well, I actually don't know what strategic is, but I imagine that the bulk of the operating capital is mine development and sustaining capital. What does that mean? Mine development, that's equipment digging, developing new areas of the mine. Sustaining capital is things like necessary equipment, trucks, loaders, whatever it takes for the company to maintain its current production levels. We can then see also the construction capital for the company. We mentioned before the A4 mine is in the process of ramping up, and you'd expect therefore to be less capital spent on that asset. And we can see that is the case from FY24 to FY25, and we'd expect that in FY26 there'd be even less. At the Matsa operation, we can see that capital spending year on year is ramping up. Now, we do need to keep an eye on this for what is the reason for that. So to establish that, we need to pay attention to what the company is saying in its quarterly updates, what it's saying in its half-year reports, those sort of things. At this point in time, I'm not seeing anything to be concerned about just yet, given that the total capital number is still relatively in line. At the Motheo operation, we can see that capital is reducing, which is expected given that the new A4 mine is finishing its development. Now, something to keep in mind is that as the operation finishes its ramp up, we would expect to see an operating cost increase, given that there would be more activity in the mine, mining whatever it is they're mining, in this case copper. So even though it means less capital, doesn't mean that that the total cost is coming down for the asset. Next, let's look at cash. Now, cash for me is really important when looking at these sort of companies. Most notably, the cash balance. It's not necessarily always the most important thing, but if you wanted to have a quick sanity check for how a company is doing this, first thing I would look at is what is their cash balance and how does it change over time. Now, it doesn't mean that if cash is going down, it's a bad thing. And it doesn't mean that if it's going up, it's a good thing. What is important is being able to understand what is driving the change, and whether that change is an acceptable reason for you. Now, in this instance, we can see from FY24 to FY25, there's about a $73 million cash balance reduction. Now, again, as I mentioned before, this doesn't necessarily mean a bad thing, but it does mean we need to ask some questions of what's changed. Now, there's a lot of information on this sheet here, and the way I look at these things is, firstly, I look at what are the biggest changes. And we can see here from cash flow from financing activities, there's some really large changes year on year. So let's look at that a little bit further in the first instance. We can see that the proceeds from loans and borrowings is a much larger number in FY25 than was in the previous year. What this means is the company drew down from a debt facility to take that money into its accounts. We can also see that the repayment of borrowings is quite a big number. So what this means is it repaid a lot more debt in the same year. So that doesn't make a lot of sense, does it? Well, actually it does. And we'll go into that in a little bit more detail. Let's look at the debt. So the company provides this explanation in its financial report. The key thing here to know, or to draw your attention to, is that at the start of FY25, we had an opening debt balance of about $560 million. The company then drew an additional $440 million of debt. Next most important thing is it repaid almost $790 million of debt, meaning that at the end of the year, the total debt that the company has reduced from $560 to $228 million. So basically what the company's done is it's taken out a new 4-year corporate revolving facility of $600 million in FY25, which is where that $440 million drawdown came from. That's replaced the existing or the previous debt facilities the company had against the Matsa and Motheo operations. This means it's got a more simple debt or funding structure. And in addition to that, the company has also shifted from having secured loans to having unsecured loans. What this means is the company has a bit more flexibility when it tries to fund new acquisitions or growth projects into the future. Effectively, the company doesn't need to provide security by way of its assets or operations. If the company defaults on any of its loans, the banks doesn't have security, automatic security over its assets. Whereas previously, they would have had security over those assets, meaning they could step in and take control of those assets. In this instance, the company is doing well from a fiscal perspective and an operational perspective. The reduction in debt is, in this case, for me, a positive sign. So overall, strong performance and a strengthening balance sheet. Let's look at the company's FY26 guidance and what we can expect to see over the course of the current financial year. Firstly, we've covered the ore production previously, but again, here we can see that ore production is about the same at each asset year on year. The numbers in brackets represents FY25 actual numbers. We can also see that the copper, which is presented here as a range, is broadly consistent with what the company or both of the mining assets achieved over the last year. I haven't focused too much on the byproducts zinc, lead and silver because this is for me more of a copper investment and these things are just bonuses on the side. Let's consider the operating cost. Now, in both instances for Matsa and Motheo, we can see that there is a notable increase in operating cost. Now for Motheo, we mentioned before that as the A4 mine is finishing its growth capital phase, we would expect to see operating cost increase. This is because there will be more activity, more run-of-the-mill mining going on, which cannot be classified as capital cost anymore. At Matsa, we can also see that there is an increase in operating costs, even though the company or the mine is producing relatively similar levels of copper and byproducts year on year. The reason for this, according to the company, is there is an FX impact between the euro and the dollar, which makes sense. The company does have currency impacts with both of their operations. The capital component has increased also as a result of the currency conversion, but also the company has commenced construction of a new tailings storage facility, which was budgeted for $25 million. So that at least partially explains why the Matsa operation has an increase in operating cost as well as a capital cost for relatively similar levels of production. Now it'd be worth keeping an eye on this. Currency risk is outside of the company's control for the most part, so it'd be worth keeping an eye on this to make sure that we can verify. So to close off, what do I think about Sandfire Resources? Well, here's what we know. At the moment, copper is a hot commodity. There's energy transition, there's supply constraints. Sandfire is a pure copper play, and operationally it seems to be doing a pretty good job. I think in FY26 this company will be one to look out for. Overall, I think this is a compelling play for copper bulls, but I'm interested to hear your thoughts. Please leave some comments in the comments section below. Please note that this is not financial advice, and ultimately, no one knows how a rock will break. Until next time, see you then.